What's it worth? That's the question today. So, how to price your small business. In this video, we are going to talk about the exact process I use to value a business for clients, to value a business for purchasers. What we're not going to do is we're not going to arrive at a value based on a guess, based on a multiple, based on some other arbitrary method, industry standard for valuing a business. Oftentimes, profitable businesses sell for much less than what a multiple would apply and put a value. Goodwill, an intangible that is often misunderstood. By the time we get through the end of this, you're going to understand how at least I value a business, and I think how it's proper to value a business, and how to price your business. So stick with me. For those of you who don't know me, my name is Chris. I'm a CPA. I've been practicing and still practicing for 33 years. I'm also a real estate investor and a financial advisor, a licensed financial advisor. I won't name the company, but stick with me. The very first thing when you talk about valuing a business, to me, it's simple. What is it you're selling? You have either one or two cases. You have a business which you don't own a lot of assets. You may rent the building, and in those instances, a small retail operation, a small cosmetic operation, hair salon, something like that, you're really selling not much, a few assets, maybe a client list or a customer list. But in those cases, perhaps a multiple is a better way to price. It's based on revenue, but that's priced up or down depending upon other factors: risk, client loyalty, customer loyalty. Is the owner in the business constantly? But I want to put that aside and focus on a business that with assets that is not typically priced on a multiple type pricing structure. So you've got the assets, the physical things you can go put your hands on and touch. Value them. It's not hard. Make a list. List the assets. Boom, you've got that. You've got to also determine when you do that, who's getting what asset. Accounts receivable, money that the customers owe. Is that going to the buyer or is it going to stay with the seller? Cash in bank. I'm not going to get into stock sale versus asset sale because, in my opinion, you should value the business the same way. It has intrinsic value. I don't care if you sell the stock or I don't care if you sell the assets. There are different tax implications, but in terms of valuation, you've got to know what that thing is worth before you can sell either one. So you got to know what it's worth. Outline, list the assets, put a fair market value on the assets. Then you look at the intangibles. Do any intangible assets exist? Trademarks, patents. We recently did a sale for an auto dealership. There's a full floor plan that's valuable. There are all these intangible assets that you perhaps can value, perhaps you cannot. So my method, I value the hard assets, real estate, land, things of that nature. And then I use something called excess cash flow. And what that basically means is if I have $200,000 worth of assets and I demand a 10% rate of return on those assets. Now, that rate of return differs if we're talking about equipment or buildings or whatever. But if I say I agree to this $200,000 worth of assets, hard assets, and I demand 10%, that's $20,000 a year. That is return that goes to those assets. Let's say the business makes $50,000 a year. So that leaves $30,000. 20 went to the assets, 30's excess. That's the cash flow that I'm getting for stepping right into a business that's already up and running with processes, employees, customers, habits of customers. All of that exists. That's worth something. What is it worth? I don't know. Are we talking about a business that has a high barrier to entry? In other words, if I went out and started one today, would it take me 10 years to get to the level that you're at, the seller? Or would it take me a year? The business that has a low barrier to entry, it takes a year. You can't command much for that cash flow. A business that takes 10 years or that has specific contracts in place, things of that nature. Maybe they have they're able to get into these chemical plants and refineries, things in our area that's common. When a person buys a business, they want to buy the stock of that business because it carries with it all of those things of value, those intangible things of value, like, hey, we already have these contracts, we already have these agreements with the plants, we can get into the plants, we have all of our certificates with OSHA and everything else. So all that's valued. Either you can or you can't put a value on it. If you can't, which I would argue that most of you can't put a value on a trademark or a patent, then you're looking at excess cash flow, and it's at a premium. It's not just how high is the barrier of entry. It is how much of this stuff is in place that would take us years to develop a history with these chemical plants, refineries, if we can even get into one. All of those things matter. So when you look at a business like that, you value the assets, and then you come up with excess cash flow. You have some of that cash flow that's the assets produce, and you reduce that. You have excess. Then you do what's called a net present value. This is what I do. I apply that, and I arrive at a net present value, today's value. If we're talking about a business that it will take me 10 years to get to the level that the seller's business is at, okay, I treat that just like a 10-year lottery ticket. So, if you win the lottery, you can get $1 million paid out over 20 years, whatever it is. I don't play. Or you can get $463,218.12 today, right? That's the net present value. You're talking about the time value of money. So you get $1 million paid out over 20 years, or you get something less today. So we look at that same example, $30,000 excess cash flow, 10 years, that's $300,000. Discount it back to today's dollars, it may be $150,214, whatever the math is. You discount it at a rate that is attributable to risk. I don't want to get it hard into math, but if you're buying a riskier business, you would discount that more. If you're buying a not so risky business, maybe it's a real estate company or something, you would discount that less. There's not a lot of risk. Without saying that, you arrive at your method for discounting those future cash flows. So what do we have? We have, what are the assets worth? Plain and simple. How much of that cash flow do our assets command? Is it all building and real estate? Very low, maybe 8% instead of 10 in my example. Then you look at the excess cash flow and your barrier to entry. And you say, look, this is a vet clinic. I can have another one up and running and take customers in 3 years versus something that may take 20 years to get up and running and get contracts in place and processes and the proper employees and go down the list. So you apply that and you come up with the value for those excess cash flows for that extended period of time or short period of time, whatever it is. You add that value to the asset value, and now you're arriving at a business valuation. It's as simple as that. From there, though, you've assumed a lot. You've assumed, hey, all of this information is correct. All of the accounting I'm looking at is correct. All of whatever. So really, when I boil it down into assets, excess cash flow, and the value, combine those two and we're done. You also have to, well, let me just restate this by saying this is where the negotiation comes in, because there are all sorts of risks inherent with any of this. And what a potential buyer wants to know is, what's going to happen after I take over? What will the customers do when the owner's no longer there? So these owners that think they've got their hands in the business and they're there every day and they've got everything right here and under control, those are sometimes the worst type of businesses to sell. Whereas those that are the owners, like, I may show up twice a week, I may show up once a month, I may just check my bank balance and make sure everything's running fine in financials. That hands-off owner, that business will sell at a premium compared to the owner that's all engaged and involved. When you've got processes in place and employees in place to handle that for you, and the business is profitable, it will sell at a premium, depending upon who you're selling it to, but generally it will sell at a premium. So you've got that. You've got, what are the financial statements like? How much monkey business is involved, for lack of a better term? Part of that arriving at that excess cash flow is normalizing the accounting. By that I mean, before you even get to what is my excess cash flow, you have got to normalize the accounting. Take out any extraordinary things. Maybe there's storm damage that you have the repairs there for, or loss of income from. Maybe there's, whatever, strange events. You take those out. Then you take out things that are attributable to the owner. Maybe there's a vehicle that's a company vehicle that the owner drives that wouldn't be needed. Those types of things. Maybe there are, insurance policies on the owner that wouldn't be needed. So you normalize what those financial statements would look like when the new buyer took over. That's what you calculate that excess cash from. So you got your assets and how much cash flow they command. Then you've got the excess. Then you've got the barrier to entry and all of these other things I'm talking about. Contracts in place, things like that, they have a value. The more value they have, the higher or longer number of years, basically, you discount those cash flows. Or the more you command for it, really. It's all it amounts to. But that is typically how I go through and value a business. And you guys out there that are accounting for your tax return, keep this in the back of your mind. Are you ever going to want to sell that business and recognize the gains that you've built? When you start playing games with a potential buyer and they come in and they look at your books and they say, why would I buy this? You haven't made any money. Oh, sure, I've made money. Let me show you why. There's a whole lot of skepticism involved. I understand you don't want to pay more tax than you have to or you should. But the more normalizing I have to do and the more explaining I have to do, the more difficult it is to put a premium on the business. Simple as that. I don't care what anyone else tells you. You're going to have these business brokers that will tell you a lot of things. But when it comes down to the rubber meeting the road, especially depending on the buyer, you're going to have, if you have to explain your record keeping and your financial records, it's not going to work good. We could talk about buyers. The buyers that typically are venture capitalists, I wouldn't put much effort into satisfying those type of buyers. They're not bad. They just know that the money is in the buy. They're looking for something that they can steal or that will pay for itself and pay them a return. If you're selling your business at a price that will pay for itself, you're better off to throw a manager in there and just walk away monitor the financials, and keep the business. If you're giving it away, I'll buy businesses all day long that pay for themselves and a return for the investors or the money people. They pay the note, they pay the return. It's a win-win. But to sell a business at that price, you're not getting fair value, believe me. So it depends on the buyer. And I would demand earnest money up front. I wouldn't start spending money on accountants and CPAs and lawyers to jump through the buyer's hoops. I would say, here's our information. If anything doesn't prove to be true, if there's a mistake, then you get your earnest money back. If what we say is actual and factual and you back out, we keep your money. Now, you put an amount on that money. What's it worth? I tell clients, enough to cover the fees for accountants, CPAs, things like that, because a potential buyer will come in with a list of demands, and 90% of the time, and this infuriates me, it looks like it just came off of an internet search. Here's what we need. Here's our typical package that we need, and they send you this 48-page long list of all these ridiculous things. In my opinion, they're ridiculous. If they were really intended to buy your business, they would want to sit down, meet with you, walk through the place, a lot of those things. Instead, they want you to jump through thousands of dollars worth of professional spending to submit something to them that they turn around and say, no, there's not enough money in it. Or they come back with an offer half your asking price. All right, I'm through ranting. You're going to get the truth from me here. You're not getting this fluff. You're not getting these videos that are highly produced and all that stuff. You're getting real experience from a person who's been doing this 30 years. So when I go on these rants, please forgive me. I don't mean anything. There's a place for everyone, and those buyers have the right to ask for what they want. And the brokers do a good service. I'm not knocking anyone. I'm just saying, if it were me selling my business and I was approached like that, it would be simple. Here's the very basic of what you need. Front 2 pages of my tax returns, financial statements for the past 3 years. You want more than that? Okay, we can talk. Let's get an earnest money contract drawn up, a non-disclosure agreement, whatever else our attorneys need to draw up, and you get ready to pony up some escrow money to go into escrow as part of this agreement. You walk away for your own reason? Fine. Here's our price. Here's our info. When you're serious, put your money in the escrow account. Then we'll move forward. You can analyze anything you want. But until then, you're not getting a customer list. You're not getting anything else. Here are the numbers. Here's the asking price. If you think we're within range, we'll let you back out if the price is just negotiated within a certain amount, maybe. So choose that. Anyway, that's it. Like and subscribe. I hate asking you guys to do that, but it really does motivate me and keep you in the community, because as I grow, I promise you, we're going to do interviews with business people and entrepreneurs who've done things like this, who've sold businesses. Thank you.